Hey, rent to retirement investors, Zach Lemaster here. I'm very excited to present to you a brand new seller financing product that has a 2.99% interest rate. You heard that right. This is a new loan product that we are very excited about here that we are going to be using, and I think will be very beneficial to many investors. As you know, our goal is to scour the nation for the best investment opportunities, as well as the best loan terms, et cetera, to make sure that you have the best resources available at your disposal to accomplish your investment goals. So let's dive right into this. All right, so what we're talking about right now is a brand new seller financing loan product that we've worked exclusively on with a builder in Alabama that is offering brand new construction houses that they are willing to offer on a seller finance loan at as low as 2.99% interest. And this is an interest only product. And so really what this means is this is a extremely low interest rate that will allow you to skyrocket your cash flow and returns for a short period of time. This is an interest only loan product that is a seller financing loan. This means you're not going through your conventional qualification criteria. You still need to qualify for this. It does require 25% down. You must close in an LLC, which they set up for you. This is specifically on Alabama new construction. This is not something, this is coming from a specific builder and seller that has given us exclusive inventory to sell for them with these given terms to our investors. Now, please note that there are only a select amount of inventory available that these are going to be offered on. So this isn't going to be something that, there's going to be hundreds and hundreds of houses. This is a time sensitive thing. If this is something that fits your goals and makes sense to you, then I encourage you to act on it, because as usual, once it's gone, it's gone. And so there is a select inventory that these are available on only with this one building team on specific inventory on new construction in Alabama. So just real quick on the loan, like what this is. So it's an interest only product. And if you're unfamiliar with what interest only is, I'll go through the numbers in a second, but essentially you're only being charged interest for a period of 2 years. It's a 2-year term, and you can extend the interest only if you wanted to, but essentially the initial term is 2 years where you're paying interest only. This allows you to cash flow dramatically more than you would otherwise. We all know with a conventional loan, 30-year fixed loan, it's generally almost interest only. All the interest is front loaded anyways. So this is a really creative way that you can come in and buy a property and cash flow significantly more, pay significantly less interest the first year, build some equity through appreciation, and save up some cash flow. Then after 2 years, you can determine if you want to extend your interest only. Of course, the rate will adjust at that point, or you can sell the property and just realize your gains from cash flow and appreciation and your tax benefits at that point. Or you can roll it into a 30-year fixed loan, which this same building team will extend on a 30-year fixed loan if you'd rather roll it into a long-term type of loan scenario. So let's go ahead and look at the numbers of this and see what they actually pan out, because I think this is going to be very interesting for people. This is something that I've not heard of. We hear about seller financing and we hear about interest-only loans, but we never hear about seller financing at 2.99%. Typically, interest-only loans, which are an option out there, are about the same interest rate that we would see right now. And so it's a way you can cash flow a little bit more, but not significantly, like when you have an interest rate that's less than half of what we're typically seeing. All right, so what we're going to be looking at is, we'll just use an example property here. This is a brand new construction house in Alabama. Again, there's multiple locations that these are being built throughout Alabama, but mainly in the metropolitan areas between, if you're looking at Huntsville and Birmingham, somewhere along that corridor between those areas, which we know is a growing area. It's the Sun Belt. So we have population growth, which we would expect to have high rental demand and appreciation both in rents and in prices over time. So the price point that we're looking at is right around 270. We're looking at a rent that's around 1770, about a 1,600 square foot house, 3-bed, 2-bath, new built, and is currently leased. All right, so what we'll do is we'll actually compare side by side a seller finance versus a conventional finance loan product. And this will allow you to kind of visualize like, hey, this is how this would make sense. So here's our typical pro forma, which you can of course see on our website and run some of your own numbers if you'd like, but I just made it easy for you, and we'll share this with you as well. But here's just a quick comparison side by side. It is important to note that these properties are typically appraising slightly above what the purchase price is. I would say on average, most of them are appraising like $5,000 to $10,000 above. This isn't a guaranteed thing, but I mean, this does show us that these are priced slightly below market value, allowing you to have a little bit of initial equity, which is rare these days. And so that's always a benefit as well. This does require 25% down. All right. And so we're going to compare a 2.99% versus a 7% or whatever this ends up being, whether you're paying points or not, on a typical conventional loan right now. So we have our monthly rent, 1770, tax, we have our insurance premium, vacancy and maintenance. And so, this kind of just goes through the typical pro forma numbers. But what I really want you to look at over here is, and I think what's really important, I'm going to hide the pro forma here so you can just focus on these numbers because I've extrapolated out the key data points here. And so let's just look at some of these. So a seller finance interest only loan product, the interest rate is obviously much lower. It's 2.99%. By the way, you do need 740 credit to qualify for this 2.99% interest rate. They will finance you down to a 660 credit score, but the rate will fluctuate. I would think will go up a point or two if you have a below 740, but 660 and above will qualify for this. Now, if we look at our conventional loan at 740 and above, you're roughly at 7% right now, give or take. And this could be, paying no points. Of course, most lenders are including points to buy you down into the sixes, but let's just look at all things kind of apples to apples, side by side. So what does this payment actually mean? A monthly loan payment for both of these loan products is on the seller finance, it's just around $500, right? So you're paying $500 of interest every month. And on a conventional loan, you're paying over double that, almost triple that, right? It's basically $1,350 is what your loan payment is on a conventional loan. Now, a small portion of this is going to principal. This isn't all interest, but it's important to know that the majority of this is interest. The way that banks do it with conventional loans is a front load interest on your first few years. And so if you look at an amortization scale, which we will here in a second, but most of this payment on a conventional loan is interest, where you are paying a little bit of the principal down, but you're still paying significantly more interest. The big thing with interest only at this low interest rate is this simply allows you to cash flow more. So if you look at the cash flow on the seller finance interest only, it's over $900 a month. This puts you over $10,000 annually on cash flow, whereas you're barely positive cash flow on a conventional finance. So this is a way where you can take a brand new construction property in an excellent area that still would be a good deal, just buy a normal conventional financing, but actually use this creative financing option to cash flow significantly more and still own the property. I know there are a lot of people that are interested in the zero money down or the 5% down options that are still available right now, at least at 5% down. And that limited cash flow sum, well, here's a way to maybe offset that potentially negative cash flow with a significantly positively cash flowing property by using the seller finance loan product. So we can see here in monthly cash flow with the seller finance product, you're at over 900, whereas you'd be just less than $100 on monthly cash flow because you're paying so much more interest. So on an annual basis, this is over 10,000, or this is about $10,000 more. So on a seller finance property with this example, you would be expecting to cash flow annually almost $11,000, whereas you're just around $1,000 with your normal loan product. Again, like I would still buy this with a conventional loan just because I know it's a new construction house in a growing area. You'll have rental increases year after year. You'll have appreciation, your tax benefits and depreciation. Like over the long term, even though this is minimally cash flowing year one, it still makes sense. It's still a good investment. But if I can be creative to actually buy this property with a seller finance interest only product where I'm cash flowing over $10,000 a year for the first few years of ownership, man, that just puts me light years ahead and makes a ton of sense to purchase. So you can see here where this makes sense, right? It's significantly more cash flow by using this loan product because of the low interest rate. Cash on cash ROI, you're about at a 17%. This is true cash on cash before depreciation, before other tax benefits or appreciation, factoring any of that. And you're around a 2% just cash on cash based on a conventional loan product. Here's the one that I really want to point out to you that is really important is your total interest that you're paying per year. So the first year, because of how the amortization scale is listed out. On a seller finance, it's all interest, right? You're only paying interest. And because it's such a low interest rate, your payment is so much lower, which allows you to cash flow more on the same property. But after a year, your total interest payment in year one would be just around $6,000 compared to using a conventional loan. If you run your amortization scale at over $14,000, right? That is over $8,000 of more interest you're paying in just the first year of conventionally financing this. And we know that changes over time the longer you hold properties. But if you can put, in this case, about an extra $10,000 in your pocket from cash flow and pay, significantly less interest, $8,000 of less interest, I mean, that just puts you light years ahead to be able to have more cash flow to work with starting out of the gate. So, after 2 years of ownership, because let's just review again, this is a 2-year interest only loan product, which you can extend the interest if that's what you want to do. If you want to extend the interest only, again, you'll have rate adjustments or whatever after the 2 years. But 2 years, you're pretty much locked at 2.99%, regardless of what the market does. It doesn't change. Almost $22,000 of positive cash flow. And this isn't assuming, at least with this metric, it's not assuming any rental increases after the first year, which we probably would see. But this means that if you buy this property with whatever the down payment was on this, I think it was roughly 60 some thousand. So down payment here was 67,000. Okay. So if we're buying this property and we get $21,000 back, like that's a pretty significant return on investment. We're getting a large portion of this capital back just in year one. And then after 2 years, we're almost 30% there. So, I mean, this is a way that you can cash flow significantly on a property that otherwise wouldn't have just crazy amounts of positive cash flow. After 2 years, okay, $22,000 of cash flow that we've received. If you look at appreciation, which, some people don't want to look at appreciation. Some people say, well, we don't know what's going to, I mean, if you're in a growing area, again, this is Sunbelt. So we have typically seen double-digit appreciation year after year in most of the markets in the Southeast that we operate on, specifically with new construction, because these are in the path of progress in these better class areas. But we used to 5% appreciation just as an example. If you want to use less than that, then fine. If you don't want to factor in appreciation at all, then, I mean, the numbers still make sense, but I think it's important just to realize because houses do appreciate. There's no argument in that over time. But at 5%, after your first year, you would have, about $13,500 of equity. And then after a second year of owning it, you'd have close to about $28,000. And this is adding first and second year. So cumulatively, you have almost $30,000 of equity at a 5% appreciation for the first 2 years. And then you have roughly $22,000 of cash flow. Here we ran a quick analysis to say if you increase rents, year after year at 2%, it's going to go up a little bit. Whereas this number, you don't have any increase in rents. I know that rents go up. I mean, even if it fluctuates year after year, but factoring that out of the equation, even if rents stay stagnant for 2 years, like because it doesn't change the numbers that dramatically, you'd have close to $22,000 either way of positive cash flow plus your equity. You're almost at $50,000 of basically net worth or between cash flow and appreciation, between cash flow and equity that you've grown after 2 years of doing this interest only, because you're cash flowing significantly more. And then you factor in a little bit of appreciation. And so what this really means is that after 2 years, you have options, right? You can either extend the interest only loan, which will, again, the interest rate will reset at that point based on wherever prime is at that point. So it may cash flow a little bit less. Who knows? But let's say that's one option is to, depending on where interest rates are, you can reset the interest only and continue on the same path. The second option is to refinance this. You can use your own lender if you want, or you can use this team's kind of in-house lending team to extend this out on a 30-year loan. They will allow you to keep it in the LLC. You can keep this in the LLC and do a 30-year fixed loan, which, it just depends on where interest rates are at that point in time. We all anticipate, the Fed's included, that interest rates will come down, maybe not a crazy significant amount, but we should start to see interest rates coming down over the next few months into next year. And so after a 2-year period, is it likely that interest rates will be less than where they're at now? Yes, even if they're not. One thing you could do is take this $22,000 of cash flow that you've earned over the past 2 years and actually buy your rate down. And that would buy you a significantly low rate. You've owned an asset that is appreciating over time. You've created cash flow and you can buy a rate long term. That's worst case scenario if interest rates are where they're at now or potentially worse, which is unlikely. But you have capital to buy your rate down if that's, what you want to do, or you can liquidate the property as well. And you can 1031 exchange it because you've owned it for 2 years. Remember, with a 1031, you need to own it for at least 1 year. You've had some appreciation in the house. And then you also have some positive cash flow too. So to avoid paying, capital gains, you can 1031 it if you wanted to. So there's multiple options here, but the point is, this is a really unique option. I've never seen seller financing at 2.99%. I didn't even see seller financing at 2.99% or even close to this. I didn't even see seller financing when we had historically low interest rates like during COVID times. Because typically, when you have a seller finance type of product, you're going to have usually a higher interest rate because the seller is extending the financing. The reason the builder is doing this right now is to refinance some of their construction loans and to get them out of their loans, and then to still hold notes on these properties, which looks better on their balance sheet. So if you want to ask, like, why would they do this? Well, this makes sense for the builder to do this as well, right? They're exiting a high interest construction loan and they're holding the paper on these things in-house, which allows them to free up some more of their financing options. So that's why it would make sense for them. But this means that there's an opportunity for you to take advantage of this and, get a 2-year extremely low interest rate to allow you to cash flow significantly more and earn double-digit returns, almost a 20% cash on cash return. In this type of scenario. In fact, your actual return on investment, when you factor in like the appreciation, when you factor in the tax benefits and depreciation, which we didn't even look at, none of that is even calculated in this scenario. You're probably over a 50% cash on cash return. And that would be something to factor in. I can do a deeper analysis if some people want to see that. I tend not to, because sometimes it confuses too many people. But yeah, just remember that remember the mortgage interest on the property that you're paying is a tax deduction in addition to getting depreciation, whether or not you're taking accelerated depreciation or not. So this is a really interesting loan product that can allow you to refinance, in a couple of years, or sell the property, or continue the interest only and cash flow a ton and earn a really good rate of return in that time frame. I don't know anywhere else where you can get, close to a 20% cash on cash return with a 2.99% seller finance product right now. It doesn't exist. And I feel excited to bring it to the community because I know that I'm bringing stuff to our investors that they haven't seen elsewhere. And likely if other investors hear about it, they're going to go, what? Because this is the kind of stuff that we're hunting for, you guys, and we're negotiating. Like, we worked with a builder to develop this product. Now, we don't have any financial incentive in this. I have no dog in the fight if you use this loan product or not, because we are not financially incentivized on the loan structure. Our goal is to help you explore all options, know what all options are out there, and then buy properties and that to add to your portfolio that makes sense for you. I do want to look at an amortization scale because this is something that is important to understand, how banks front load interest. And so this is the same property on an amortization scale, which is basically over a 30-year period, how your principal and interest payments are divided. If you look in your very first payment on this property, your payment is 1346, right? We rounded to 1347 on the other sheet. Your principal in this is basically $166, and your interest on your first payment is $1,180. And so what this means is this is majority interest. And I think this is important to understand and conceptualize here, because when you take out a conventional loan, it's basically front-loaded interest. You're paying so much interest. Now, if you're 10 years into the loan, it kind of shifts to where you're paying more principal, and that's a benefit to holding properties over time. But you just look at the amount of interest that you have to pay. So over the first year, you're paying down principal at $160 to $170 a month, which is negligible compared to paying 10 times that in interest. And so over the first year of interest, you would pay $14,000 of interest. And that's if you're going to hold this property forever, long-term, that's okay. It's just the way it is. You're paying the interest either way. You get the tax deduction, and you hold this property for a significant amount of time, and the tenant's paying the loan off for you. So eventually you'll start chipping away at the principal, quite a bit. But here's like the big picture concept. And I think why this really makes sense is because, one, interest rates are higher. They're not crazy high if you look at history, but considering where we've come over the past year, they're higher, and they're anticipated to go lower. Okay. It's anticipated that they will drop, maybe not significantly, but some. And so we're kind of at this peak interest rate environment right now. So most people that bought investment properties or primary residencies, or over this past year, or even are buying now where they have higher interest rates, they will probably refinance their properties when interest rates come down, especially if it's a point or more. They will probably refinance their properties because that changes their payment significantly. And they have not held the property for a long period of time, because every time you refinance, you reset this amortization scale and you reset the amount of interest, right? You're paying your interest to begin with. So the concept is that you're refinancing your property within a couple of years. You're paying more interest by doing that if you're going to refinance. Now, over the long term, it makes sense to refinance because you're getting a lower interest rate. But my point is it makes more sense to do an interest-only product right now because your plan is probably to refinance either way. So you might as well cash flow more right now and buy tens of thousands of dollars by using an interest-only product, and then just refinance in a couple of years like most people are going to be doing anyways. That's kind of the alternative. So if we look back at this analysis to see, all right, well, does this make sense to do or not when you're comparing? Let's say, okay, we've identified this is a good area to invest in. It's brand new construction. You have a couple options. You can buy it with a normal conventional loan, or you have this unique loan option at interest only for 2 years at 2.99%. Well, why not use that to buy multiple properties? I think you can buy up to 5 of these, by the way. You can't buy a ton of them. You can buy up to 5 of them is what they'll qualify each person for. Why not do that and cash flow over $20,000 more than you would otherwise over those first 2 periods and go through the same refinance that you would probably anyways if you bought conventionally? So there's really not a reason not to do this. So just in summary, of course, you guys, I can be long-winded sometimes, but I think you sense my excitement in this loan product because I think this is a really creative option. I've never seen anything like this, at least this low of interest for a seller finance. So I know there's going to be a ton of people that will be excited about this and that will benefit from this. And unfortunately, there's just limited inventory. So it is a time sensitive thing. And those that are serious about it, they need to take action. And so what does the process look like? The first thing that you need to do, there's going to be a link on this video, any emails we send out, or if you're talking with your investment strategist, the first thing you do is actually click on the link to pre-qualify with the lender. It's just like going through a mortgage application. However, it's not a conventional Fannie Mae Freddie Mac loan product. It's less stringent criteria to qualify for this. There's a few key points you need. You need to have your last pay stub. You need to have 2 months bank statements showing you have the 25% down to use for the property that's liquid, past 2 months bank statements to show liquidity, 1 year tax return, and they're going to run credit, right? And so that's really quite criteria. Again, 740 credit or better will qualify you for the 2.99%, but they will qualify you down to 660. And so the first thing that you do is you click on the link to fill out the application. It's within 24 hours. This is not like you're used to dealing with banks that are so slow. This is dealing with an in-house seller finance mortgage product that they are offering seller financing on. And so it's quick. The closing on these will be about 10 days, just so you're aware. So you fill out the link. The first thing that you do is fill out the link. You get that approval. You email that to your investment strategist immediately. If you don't remember who your investment strategist is, just email it to sales@renttoretirement.com. Again, that's sales@renttoretirement.com. And we will have someone follow up with you because we're building a wait list. Basically, as soon as you get pre-approved, that's when you go on that wait list to actually identify the properties. Once the properties are gone, they're gone. Maybe some more will become available in the future that are offered as seller financing, but you just need to get your pre-qualification done first. And then our team will reach out to you. Send that to us, and then we'll schedule a time to actually identify the specific properties that makes sense for you. Again, this is a seller finance product only available on specific new construction in Alabama with a specific building team. This is not something that, you can look at other options or other locations with. This is directly from the builder. A couple other key points to note is that you need $10,000 earnest money. And so once you have your pre-qualification and you actually turn in all your documents and clicked on that link that we've asked you to, send that back to us. We'll have about 48 hours to identify the properties that you would like to and reserve them. You sign a contract on them, and then that means you've secured those assets. and we do need to move somewhat quickly on this. And then you wire in your $10,000 earnest money. If you want to have a property inspection or additional due diligence, like you got to do that immediately because closing is about 10 business days on these. So they'll go ahead and close the properties, and then you get set up with management. Many of these are already rented, and so they'll be cash flowing from day one. If they are not rented, they are in leasing now. All of these are already completed builds, and they're either rented or in the leasing process. And so the expectation is that they'll be, leased out before your first interest payment is due. And so you're not having to come out of pocket additional interest, which I think is the following month. You get like a 1 month elapse period. And so it's about 45 days, give or take, depending on when you close. So if you have additional questions, please reach out to my team and we'd be happy to fill in the gaps for you guys. We're super excited about it. The numbers speak for themselves. This is a great way for you to grow your portfolio and create immediate cash flow. I do not know of any other loan products out there that can get you, below sub 3% on a seller finance note that allow you to have almost 20% cash on cash return in brand new construction in a growing area. It just makes all the sense. So reach out if you have questions, click the link below to apply and send us your approval once you have it. That's the steps. All right, guys, hope this has been beneficial for you. Of course, reach out if you have any questions. Thank you.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.